I am a gold buck also bond, but I'm still standing with the 1250. Where I maybe moderated it, it's because of the I have to say, gold has stand out strong here for the last couple of years. If you look at silver, it never stood out as strong as that. If you look at the gold miners, it never stood as strong as that, which are indicators to me also. And if you look at that, normally when you have a strong gold market, a gold bull market, you would see that silver and gold miners were actually leading gold. You haven't seen that for the last couple of years. So I think gold is overextending itself at this point here. And if you have a deflationary bust that I'm talking about, the recession, and you will have bank crisis, you will have, there will be a lot of trouble around the world and liquidity wise as well. Gold will not do well.
In recent discussions on gold price targets, market and macro expert Henrik Zeberg, founder of the Zeberg Report, highlights technical indicators like Elliot waves, suggesting an impending drop in gold prices. Zeberg advises against buying at current levels due to the anticipated deflationary bust he foresees. Gold prices have reacted to this sentiment by declining, hitting a 3-week low in earlier U.S. trading. Cathie Wood asserts that deflation is already underway in the United States across various industries. She predicts this will prompt the Federal Reserve to initiate a significant interest rate cutting cycle. Zeberg notes an unusual trend where gold is strong, but silver and gold mining stocks lack resilience in the current market. Typically, gold mining stocks outperform gold bullion in bull markets. In the ongoing gold bull market since 2015, mining stocks surged by over 182%, surpassing gold bullion's 78% returns. Looking back from 1970 to 1980, the gold spot price multiplied over 24 times, starting at $35 per ounce and peaking at over $850 per ounce in late January 1980. Similarly, silver's spot price multiplied more than 38 times, starting at $1.29 per ounce in 1970 and reaching $50 per ounce by early 1980. These observations suggest potential shifts in the usual market dynamics. Drawing parallels with the 2008 financial crisis, Zeberg points out that gold and silver initially experienced substantial declines before rebounding. This echoes the dynamics witnessed during the recession of 2008, where silver prices only peaked in 2011. The Great Recession impacted the price of gold, initially declining after the Lehman Brothers bankruptcy, but rebounding swiftly to end 2008 in positive territory. How will investors navigate these challenging market conditions, and what strategies should be considered in light of the potential shifts in the gold market? Write your thoughts in the comment section. Before you watch Henrik Zeberg's interview, subscribe to our channel and give this video a big thumbs up.
My gold call still stands. And what I said back then is that it was one of the places where it first became visible to me technically and in the charts that we were going to see a plummet due to the structures that I see, the Elliot waves and so on and so forth. And people don't like that because we have all the gold bucks there and they don't like this call. And I am a gold person myself. I am a gold bull also, but no long term. At these levels here, I just don't want to buy because as again, a natural consequence of what I'm saying here with a deflationary bust is that there will be a liquidity crisis. And the reason why people hold gold, and they don't really consider that, the reason why you want to hold gold is when you have a liquidity crisis, gold will always be a way to get, liquidity, meaning US dollars. So gold is a good thing for that. And also long term, because when you have inflation, it moves up, gold will, follow in price. And it's the same and stable kind of, product commodity. So I am a gold buck also bond, but I'm still standing with the 1250. Where I maybe moderated it, it's because of the, I have to say, gold has stand out strong here for the last couple of years. If you look at silver, it never stood out as strong as that. If you look at the gold miners, it never stood as strong as that, which are indicators to me also. And if you look at that, normally when you have a strong gold market, a gold bull market, you would see that silver and gold miners were actually leading gold. You haven't seen that for the last couple of years. So I think gold is overextending itself at this point here. And if you have a deflationary bust that I'm talking about, the recession, and you will have bank crisis, you will have, there will be a lot of trouble around the world and liquidity wise as well. Gold will not do well. Why would you want to go buy gold if you need to pay off your bills? You need to pay down your debt levels and your debt. I think there is a misconception again about why I'm calling for this. I mean, I'm not anti-gold or anything like that. Actually, I'm the opposite. I think the next monetary system that we are probably going to see at some point will be based on gold, because I think that's a sound way of having a reserve currency or a reserve basket currency that is fixed to something, so we just can't keep printing money. The call is because of the deflation that I see, because of the recession that is going to set in 2024, as I see it, and into 25. But the moment when we get the Fed coming back in again, and we get, when they try to push or to inflate the economy again, that's the moment I'll be one of the first buyers of gold. But again, please note also, if you look at the gold miners, which is actually my main play here, is the gold miners have been declining. Also, I think they are way down in 23. I mean, they were down a lot by since June or something like that. I haven't followed closely just the last month here, but so I'm expecting a major low to come in miners, in silver and in gold when you see the recession sets in. You had that in the financial crisis as well, and right now we are seeing exactly the same kind of development before the financial crisis. Gold fell by 33%, I think it was, from March of 2008 until September 2008. 6 months, it fell 33%. And I think silver in the same period fell by 60%. So I'm not against gold, and I think that's where I've been misunderstood. What I'm just saying is that when you get that deflationary bust, you don't want to hold. I mean, if you want to time it, you don't want to hold precious metals. You don't want to hold commodities at all.
Henrik Zeberg asserts the certainty of a recession in 2024, supported by various indicators. He anticipates significant changes unfolding within the next 6 months. Despite the U.S. economy avoiding a recession in 2023, the likelihood of one in 2024 remains at approximately 30%, double the average rate of 15%. Zeberg criticizes the Federal Reserve's attempt to curb inflation through monetary and fiscal stimulus, labeling it a mistake, particularly given existing supply chain challenges. He predicts that this overextension will backfire, setting the stage for a struggle against deflation in late 2024 and into 2025. Ahead of the December meeting, an economist argues that the Federal Reserve's dangerously high interest rate hikes are temporary, suggesting potential cuts in the first quarter of the following year. This viewpoint aligns with broader economic predictions that deflation is on the horizon, prompting the Fed to scramble in response to the changing economic landscape. Let's get back to the interview.
And they've been good at understanding and forecasting the Fed's rate cut cycle, what they do. But what I again, because I follow the economy, I don't follow the Fed. I don't see the Fed as a leading indicator on the economy, as many people do. What I look at a 2-year rate yield, U.S. yield, that is going to plummet. And it's going to plummet faster than what we saw before the financial crisis. And if you look at the first 2 months here, since the October top, we actually see some of the strongest declines in the yield level, market yield levels in U.S. 10-year and 2 years and other yield levels than we've seen before. And this is an indication of the severity of the crisis that we're heading into, and which is also supported by the leading indicators that I follow. What the Fed does, I mean, they will follow the 2-year yield level. That's what they normally do. So when we see a top in that, they will follow it down, not the other way around. So if you ask me what the market seems to be, what would happen in the market, I think we're going to see plummeting market rates. And when we talk in a year's time, so let's say, please invite me in January next year, market yields will be down to the lows of what we saw before the spike we saw here in yields. It's going to be really a tremendous drop here over the next 12 months. So again, if you want to positioning yourself there, I mean, I think bonds will be a fantastic place to be in at this point here, because the recession, I don't see how we can get through 24 without seeing the recession. I mean, there are so many indicators that it's going to come, and but also that again, it's not here right now, but probably in 6 months' time, things will be a lot different.
Interesting, because
and saying recession will be the moment when yields really starts to plummet. That's always been the case. And the moment you see the recession set in, that's where yields are just dropping really hard. And yes, the Fed will follow there. So will it be 3? I don't think it'll be 3. I think it'll be more. But depending on, again, when the recession sets in and market yields. But they should be already at this point here, if they should really be front running the market and the economy, they should have understood long ago that what they did with the latest rate hikes was an overextension of what they needed to do, because the market dynamics was already pushing inflation down, and it was clear. I mean, there are so many indicators of it, and I said it even on my live shows. I said I think this was not just one or two bridges too far. I think it was three or four, five bridges too far. They got scared of their own ghost that they thought they have created in an inflation ghost, not understanding, and this is really shocking and surprising to me, that the real economy is what drives inflation. The real economy is supply and demand. And if you're going in and you're boosting the economy monetarily and fiscal stimulus into a supply crisis, well, then you're going to get inflation. I didn't expect it to move that high. I'll be fair to say I didn't expect inflation to spike up to 9%. But what I think the Fed was thinking that they did was that they, through their money printing, actually had created this, and now they wanted to really get it down again and get the genie back in the bottle, and that's why they went out and went so hard on inflation and rate hikes. But I think it was a way overextension of what they needed to do, and this is going to haunt them in 24, late 24, and into 25, because they will be fighting deflation soon again.
In their 2024 Outlook forecast, analysts at BCA Research said that they expect gold prices to rally to $2,200 this year. While many gold investors continue to watch the Federal Reserve for signs of easing, the analysts at BCA said that plenty of other factors support elevated gold prices in the new year. As Henrik Zeberg signals a potential drop in gold prices based on technical indicators and the anticipation of a deflationary bust, how will these conflicting forecasts influence investment strategies, and what critical factors beyond Federal Reserve actions might shape the trajectory of gold prices in the coming year? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Surprisingly, around 19.8% of our viewers have subscribed. We aim to reach 5,000 subscribers as soon as possible, and your support could make a big difference. Thank you for being a part of our community.